Hello and welcome to the second webinar of the Understanding series. My name is Hyrule Lutfi from the firm, and I'll be your host for tonight's proceedings. Recently, Luke, Paul, and Brendan got together and realized that although we offer different services, we all had clients that are after the same thing, a greater understanding of how to best manage their finances. That's where the idea of the Understanding series was born. We're going to be running webinars on a regular basis, covering a broad range of topics, giving our clients the opportunity to gain a better understanding of all things financials. We also know that your time is valuable, and you've given up your Wednesday night to tune in, so we're going to try to keep it short and sweet. For our second webinar of the series, we're going to take a look at understanding of risk. Our two experts will be looking at this scenario from a range of perspectives. Brendan O'Reilly from More Mortgage Option will be discussing loan structuring, strategies you can implement to minimize your risk from a huge range of angles, the lenders, your tenants, and even the tax office. Luke Smith from Dragonfly Financial Services will be discussing financial risk and how you are able to create a market of exchange for your greatest asset, your income. He will also touch on the implication of not having cover when it comes to retirement planning. Without further ado, I'd like to introduce Brendan O'Reilly. Brendan has over 7 years' experience in the mortgage industry and has demonstrated a flair for investment finance. His depth of knowledge in this area is impressive and explains why he's able to develop a strong and lasting relationship with his clients. And with that said, I will now hear from Brendan.
Thanks, Hyrule, for that kind introduction. This evening, I'm going to explore loan structuring. Now, there's two ways a lender structures your loan. It's either going to be cross-collateralized or standalone. Now, I'm going to talk about what impacts this can have on your future goals and how it could leave you exposed to current unknown risks. I'll start with cross-collateralization now, or also known as cross-securitization for people who can't say collateralization. This is when a lender takes multiple properties as security for a single loan. Now, what does this actually mean? Now, tonight I'm going to give a real-time example and what impact it can actually have over the medium to long term. I'm going to start with an example now. Mr. and Mrs. Wilson decide to purchase an investment property using the equity in their family home. So they approach their existing bank to do this. Now, as you can see, they've got property worth $500,000 and a home loan worth $120,000. So they've got quite a decent amount of equity built up in the property. Okay, so the bank says, yep, no worries at all, provides them a loan for the full purchase price and also lends them an extra 5% to cover stamp duty, legal fees, other purchase costs. The bank provides them an investment loan and they take security over the investment property and also the family home at the same time. Now, a couple of years pass, Mr. and Mrs. Wilson decide that they want to purchase another property, and again they approach their existing bank. So it's all gone pretty well. Properties have gone up a little bit in value over time. So investment property 2, they get a loan again for 105% of the purchase price, so that's 100% plus the stamp duty legal costs, and the bank gives them a loan secured by the property they're purchasing, investment property 1, and also the family home. Okay. Time goes on again and they decide to purchase a third investment property. Again, same sort of thing. They get a 105% loan from their bank. The bank this time secures by the property they're purchasing, investment property 1, 2, and the family home. Now, why would the bank do this? Now, the more important question is why wouldn't they? How easy is it to refinance away from this particular lender in this case? Very, very, very difficult, especially if the last loan is a fixed loan for a certain period and it's across all the properties. Now, the bank has complete control and can manage their risk against the client. Now, that can be done in lots of ways by not releasing further funds, convert the investment loans to principal and interest even, and make the client actually pay back the loans, and could have a huge effect on cash flow. Now, Also in this circumstance, the bank also basically takes more security than most likely necessary in order to protect their interests. Okay, now in the example, if they fix that last property, fix that last loan, and it's secured by all the properties, if they went to sell any property, that loan would have needed to be broken. Now, that's going to mean that they're going to get a lot of break costs involved, or most likely, and actually recently I saw a quote from a client, and in this situation it was a 5-year fixed loan and the quote was over $35,000. So it gives you an idea of the numbers that we're looking at. Now, just for the record, I didn't arrange that loan. Now, cross-collateralisation, negatives for the client. Now, first of all, the entire property portfolio is seen as a single lending proposal, and each property isn't taken into account on its own single merit. This can affect all sorts of things, including future borrowings. Now, the bank starts generally getting nervous with a client about $1.5 million in borrowings, regardless of how much equity a client has. And banks start factoring further buffers when clients try to borrow more funds, and generally will be less willing to further more credit. Equity dilution, this is quite an important point for clients who have property in multiple states in Australia, because all the property markets move independently. So if you have a property in, say, Melbourne that's underperforming and a property in Canberra that's overperforming, these will cancel each other out, and the bank won't be willing to provide any further funds for more properties. And most importantly, I believe, is the banks have the control in the event of a property sale. Now, this can have a huge effect if you're looking to, say, sell an owner-occupied property and upgrade, because that property is actually tangled in with all the investment loans. So the bank are well within their rights to use the sales proceeds to clear or bring down the investment debts, and in that case, it actually reduce the cash deposit you'd have for the next owner-occupied purchase, which would then be, so it's not very tax effective. Okay, elaborating further, now what if a lender says no? Now this can result in the sale of a property at the wrong time, and if you lose your job, and you haven't spoken to Luke about income protection insurance, and you fall behind on an investment loan, now the bank can take everything, including the family home, and you'll be on a current affair before you know it. Now the alternative. Now it's not all doom and gloom, because it's all how the loans are structured. Now standalone securities would have been a much better way to go, and the way it works is that we arrange a single loan secured by the investment property up to 80% of the purchase price, and the remaining 20% plus the 5%, so we're still providing 105% financing, but the 25% comes from the family home from an equity facility. Now, this is just demonstrated here. As you can see, 20% comes from the property 1, sorry, 80% comes from investment property 1, and 25% is secured by an equity facility in the family home. Again, fast forward, things are going well, it's the exact same scenario as before, we just duplicate it. So an 80% loan against the investment property 2, the remainder coming from the own home. Now, this does multiple things. It means that each individual property is seen on its own merit. Therefore, again, a lot more flexibility. We can talk about different lenders for different properties. So if one lender has a really cheap fixed rate that you want to take advantage of, you're well within your rights to do this in this situation. Further risk reduction strategies. Now, very, very important to keep non-tax deductible debt and tax deductible debt separate facilities. Now, in that event, it just means it's a lot more clean cut, and in the event of an ATO audit, it's very simple. You've got your investment borrowings and you've got your non-deductible borrowings, and they're completely separate. Also, when investment properties increase in value, increase the borrowings against it and reduce the borrowings against the owner-occupied property, again, reducing the risk against the family home. Consider using multiple lenders when building a property portfolio. So this keeps lender exposure levels down, and also it's quite important, some people like to have the owner-occupied dwelling separate with a different bank than the investment properties, which is even further risk reductions. Always have significant buffers in place. So this is quite a simple one, but it's amazing that we could get caught up with buying properties that we don't really think about this. Now, what if all properties are untenanted for 3 months? Can you afford to hold on? And another rule, only fix a loan if it is standalone. Excellent. Thanks, Harul.
Thanks, Brendan. You certainly provided some great insight into how loans should be structured, and I'm sure you've given the listeners plenty to think about. Brendan, here's a question for the benefit of the listeners. How would a client know if their loans were cross-securitized?
Great question, Harul. Now, check your loan documents. Now, it'll be on about page 8 or page 9, normally hidden right at the back in the fine print. But most likely, if you've purchased investment properties and you haven't told the bank directly not to cross-collateralise, it's most likely that they have done that. So, again, in the art of it, if you want to continue to buy properties over time, standalone securities are the way to go.
Okay, great. Thanks for that. And now we will hear from Luke Smith. Luke Smith has worked in the financial services industry for over 12 years and is the director of Dragonfly Financial Services. Luke specializes in self-managed super fund as well as personal and business protection. Actually, Luke recently won Wealth Protection Advisor of the Year for 2012 across his national dealer group. On that note, I'll pass to Luke.
Thanks, Harul. That's a lovely introduction, and I really appreciate it. Welcome, everybody, to our second session. And tonight, as the slide says there, I'll be talking about income protection. What's really at risk? Here's the standard disclosure these days to say that anything I say cannot and will not be used against me in a court of law, and is general advice only, should not be followed without further consultation. So, why protect cash flow? Income protection is a savings plan that allows individuals to guarantee a specific level of income in the event that they are unable to continue working on a part-time or full-time basis. Generally, 100% of the premium paid for this guarantee is tax deductible for the life of the contract. Your ability to earn money is effectively your greatest asset. Cash flow underpins lifestyle, family expenses, interest costs, and all of your accumulation plans for the future, because it's your income that you intend and save for a rainy day. Remember that when you do claim on the benefit for income protection, it is assessable income. Therefore, you should provision a suitable amount of tax, because the ATO will want their slice. So what types of cover can we take advantage of? Two styles of contract that are generally available in the market. We have the agreed value policy, and we have an indemnity contract. An agreed value policy allows you to secure the highest level of income in the 3 years prior to the date of claim. That is the level of benefit they will calculate if you are unable to work after your waiting period. An indemnity contract is slightly different, because at the time of claim, what they do is they take into account the income you earned 12 months prior. Now, generally, indemnity contracts are approximately 25% cheaper than agreed value policies. However, there's a catch. You need to make sure that you're in an occupation that provides you with a consistent level of income. And what I mean by that is, if you work in the government and you're paid the same amount of income all of the time, an indemnity contract would be suitable. However, if you are a contractor, self-employed individual, or somebody that works on a commission basis and your income tends to fluctuate, it's important that you secure your monthly benefit, because you don't want to be paying for something that you would not
The
be able
broadcast is now
to get.
starting. All attendees are in listen-only mode.
Now, what affects the premium? Some of the key factors that impact the cost of the cover include the occupation classification, i.e., what do I do during the day in my job? How old am I when I take the policy out? Do you smoke? Do you not smoke? Are you in good health? And what is the waiting period of the policy? Obviously, there are two other considerations that we need to take into account here, because not everybody is in the same physical and mental situation. We have loadings and we have exclusions. A loading is where the life insured is required to pay an additional sum of money on the premium because they don't bring to the table a standard level of acceptance required by the life office. That may be that your BMI or body mass index is elevated, you have a history of diabetes, cholesterol, blood pressure, or a range of other medical conditions. It's not to say that you can't get fully underwritten with a standard contract, it just means that they're prepared to accept you, you're going to pay a little bit more for it. Then we have exclusions. An exclusion is something that is removed from the contract from its inception. This may be that you've had a knee reconstruction, you've had a shoulder reconstruction, you have a history of spine damage, so there may be a spinal exclusion. Each case is taken on its own merit and can be reviewed at any point in time. So if you do have an existing policy with any sort of loading or exclusion, it is always very, very beneficial to make sure that it is reviewed because your situations, your health and your recovery can always change and improve. So what are the other two key benefits when we work out what we're going to take out to protect our cash flow? The waiting period. The waiting period is the time frame that you can fund yourself before you need the benefit to start. This is impacted by sick leave, annual leave, cash in the bank, money in an offset account, or anything that you could gain access to fund lifestyle until you needed to draw on the policy. Obviously, the longer the waiting period, the cheaper the premium. That brings me to the benefit period. The benefit period is the duration that your benefit payments will be paid whilst you're on claim. Generally, we can take everything from 2 years right up to age 70. And the big issue we see here is that most superannuation policies these days only have a 2-year benefit period. Now, for people that are 63 years and under, most of us will be working for much longer than that. So it may be that you need a personal contract over a super contract to ensure that your mortgage and your lifestyle are secured. So how can we structure this contract? Two ways that we can take this into account. One's a step premium, the other one's a level premium. And as the name states, the step premium is calculated using your age next birthday over the life of the contract so that in later years, as the perceived risk increases, the cost of your cover goes up. With a level premium, it is an agreement at the age you take out the policy to ensure that the cost does not change right through to age 65. And we've got an example on the next slide that illustrates the difference over time between stepped and level policies and the long-term benefit of planning ahead. So here we can see it's shown to us graphically. The blue line is a step contract where we see in later years the cost going up and up and up and up like a slippery slide. And then we have the green line running across the bottom, which is a level premium contract that was a little bit more expensive for the first few years. However, from the break-even point of about age 35, we are in front and significantly in front if we look at the premium bar at the top of the screen. So you can see here it really does pay to plan ahead and consider what you do need both now and in the future. So why is cash flow so important? Most homeowners borrow to buy their first primary home or an investment property at a ratio of 80-20. There's 80% from the bank, there's normally a 20% deposit, or these days you can get them with a slightly higher level of gearing. Most loans are there for 30 years, so we're going to work for the majority of our natural life to pay off our mortgage and live the dream. The bank requires regular payments of interest, and they also have the right to review the loan if payments are not consistent or missed over the life of the borrowing. Mortgage insurance does not protect you, it secures the bank. And for those that attended our last webinar, Brendan confirmed that mortgage insurance is there to protect the lending institution, not the individual. This is very, very important because a lot of people are under the misapprehension that mortgage insurance secures their debt. It actually just secures the lender. So what's really at risk? The capital in your home is only equity if it can be used to service your interest costs. What that means is the money that you put in as a deposit, you can't actually pull out because it's the 20% that the bank requires to lend you the original amount of money. So that money has effectively been quarantined. The bank can sell your home and recoup the cost of the loan if it is called in for any reason. And it's important that you value the long-term equity that your income provides you. And we can see that in the example at the bottom of the slide here. Take a 30-year-old individual in an administrative role earning $100,000 a year. He would have, or she would have, the ability to protect 75% of their income and receive $6,250 a month, which is 75% of $100,000, right through to age 65. So from 30 to age 65, they've been able to ensure a cash flow benefit of $2.625 million. So how is value created? For any item to have value, you must be able to sell it. There must be an effective market of exchange. There's a secondary market for most things. All homes let you sell your property. Car sales let you sell your home. So if I no longer want something that's mine, I can sell it at the market rate and receive the cash in lieu of the asset itself. However, the value of your salary is directly tied to your labour. If you're unable to work, who is going to pay you to stay home? I don't know many employers that advocate this sort of policy. So if you are unable to go into work on a regular basis, be it full-time or part-time, it's important that you are paid what you are worth. Guaranteeing cash flow. Income protection effectively allows you to create that secondary market for your labour. Just like all homes and car sales, the Life Office puts a value on your future cash flow for which you pay a premium. This is effectively a savings plan allowing you to benefit from the leveraging instrument that guarantees a specific result, i.e. 75% of your gross income, through to age 65 in the event of a claim. So how does that impact the family? This is a serious consideration from a planning perspective, which we see on a regular basis, and this cannot be understated. Take, for example, the average child in a family. Most mortgages these days are $400,000. So at 7%, as an example, you'd be paying interest of $28,000 a year. The capital required in mum and dad's superannuation to generate the same level of income at 5% would be $560,000. So in this scenario, little Billy's decided not to take out a contract because it'll be okay. And as a result, mum and dad, being the parents that they are, will do anything to ensure their son's security. That may result in them paying the mortgage on his property and directly impacting their own retirement objectives. So an income protection policy for a 28-year-old administrator would be $840 before tax deduction, and it would pay a monthly benefit of $5,000, which would more than cover Billy's mortgage payments. As a parent, which would you rather pay? $28,000 a year in interest, which is lost, or $840 in premium to ensure your own financial stability and that of your son or daughter? You also need to think to yourself, how long would it take mum or dad to recoup the money spent prior to retirement if they don't have the capacity to continue adding to superannuation because they've already retired or are working on a semi or part-time basis? So in summary, what are our key points? Protect your greatest asset. Protect your ability to earn. Ensure the waiting period is appropriate. Create a market of exchange for your income because nobody will pay you to stay home and do nothing. And for parents, protect your kids and indirectly protect your retirement. You may wish to split the cost of a cover because what we tend to find with children these days, and I say children sub 30, 35, the two big answers we get when we talk about protection, it's okay, I'll be all right. And if they don't say that, they generally say, it's okay, mum and dad will sort it out if anything goes wrong. The only problem is, a lot of mum and dads out there aren't privy to that discussion. So if you want to protect your retirement and your ability to fund lifestyle, you then have the ability to pay the premium for your child, split their costs, or pay it for them until they're in a financial capacity to fund it themselves. And with that, that brings me to the end of my presentation. So we can see here on the screen, there's my email address if anybody has any questions. Brendan's information is also there. So if anybody would like to shoot through an email for any additional information, I advocate people to review their policies regularly because underwriting conditions, benefits, inclusions, and your own physical attributes change over time, and we can always look to try and reduce the cost and maximise your benefits going forward.
Thank you very much, Luke. That was incredibly informative, and you've certainly given a lot of people to think about, and it's definitely something we all need as a minimum. I also have a question for you, Luke. Do you find most people come to see you with a preconceived idea of what various protection options are going to cost?
Harul, you've hit the nail on the head. People come in and we discuss risk protection and cash flow planning as part of their overall strategy, and the immediate answer I get is, oh, I can't afford that. That's a bit like going down to a car lot and assuming you know the price of a Ferrari when really all you need is a Commodore. So it's very important to structure something for what you need both now and going forward, because you don't need a Ferrari to deliver bread, so there's no point paying for one. And because of the way policies are structured, it always pays to ensure you've got the sharpest premium with the best contract with the most inclusions for your specific situation.
Okay, that's great. Well, that concludes tonight's webinar. I hope you have learned something tonight. As always, if you have any questions, please email them to the email addresses on the screen, and Luke and Brendan will try to get back to you as soon as possible. We would love to take live questions. However, due to the number of participants we have logged in today, it might be a bit tricky and time-consuming. Once again, I would like to thank you very much for logging in. We have another session in November where we will be discussing gearing in superannuation, as well as another accounting topic that has been requested from our last session. Thanks again for your time, and we look forward to talking to you again in November. Have a great evening.